government contracts. The reality today.
Milestone. They hit one. They are a generative AI data.
Of what Block did is universal.
Massive retail sell-off we saw on February 27th. The recent price action is an irrational source competitors like OpenSearch.
Agreed entirely.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
On February 27th, 2026, the share price dropped 15.4%, and trading volume, well, it surged by 55.72% compared to the previous session, reaching $0.39 billion.
Right. And that is the central anomaly we have to wrestle with today. Because the obvious question is, how exactly does a company deliver a massive fiscal Q3 2026 earnings beat across every single key metric, yet immediately experience this kind of high-intensity market volatility, not to mention the massive off-exchange institutional maneuvering we are seeing beneath the surface?
To me, the narrative is actually quite clear once you separate the noise from the data. The recent price action is an irrational microstructure disconnect compounded by sector contagion, which is entirely masking Elastic's pristine fundamentals and massive smart money accumulation, proving it is a foundational AI infrastructure asset.
And my counter to that premise is that you cannot dismiss the structural reality of how this asset is trading. The heavy reliance on opaque dark pool mechanics, activist institutional maneuvering, and very real sector-wide TAM, total addressable market fears. These present legitimate structural and strategic risks that justify the market's repricing.
We should start by looking directly at the divergence between the underlying business reality and, well, the retail panic we've witnessed over the last few weeks. If you look closely at the Q3 FY 2026 financial renaissance, the numbers are undeniably robust. Total revenue hit $450 million. That is an 18% year-over-year increase, decisively beating the $438.38 million consensus.
Revenue beats are backward-looking, though. The market is a forward discounting mechanism.
Which is exactly why the metric that truly anchors my perspective is the current remaining performance obligations, the CRPO.
You are referring to the $1 billion threshold they just crossed.
Exactly. They crossed a massive psychological and financial milestone. They hit $1.06 billion in CRPO, representing a 19% year-over-year increase. For anyone not spending their days buried in enterprise software spreadsheets, CRPO is the ultimate leading indicator. It is contracted revenue. It is money that is legally locked in and expected to be recognized over the next 12 months.
It is the guaranteed pipeline.
Precisely. This kind of forward visibility isn't theoretical. Coupled with 21% growth in their sales-led subscription revenue, it proves that Elastic is successfully pivoting. They are no longer just a search utility indexing logs. They are a generative AI data platform. So, when you weigh this fundamental execution against the market reaction, the sub-$60 price level is a rare entry point.
I come at it from a completely different angle, because you simply cannot evaluate an asset in a vacuum, completely ignoring the macro environment and the reality of the trading mechanics surrounding it. The massive drop on February 27th did not happen in isolation. We have to look at the broader software sector sell-off, specifically the contagion triggered by the digital payments company Block, when they abruptly slashed over 4,000 roles.
That was 40% of their workforce. A drastic reduction, certainly. But Block is fintech. Elastic is search and AI infrastructure.
But the implication of what Block did is universal across enterprise software right now. This AI unemployment fear is not an irrational retail panic. It is a perfectly legitimate, necessary recalibration of the per-seat software TAM.
So you think the total addressable market is fundamentally shrinking?
It has to. If autonomous AI agents are doing the workflows previously done by junior analysts or customer service reps, you don't need the human. And if you don't need the human, you don't need the software license for that human. Furthermore, the supposed smart money accumulation you mentioned, we will get into the details shortly, but it is highly active, it is disruptive, and it is fundamentally altering the company's governance and risk profile.
I see why you think that, but let me give you a different perspective on the Block contagion. and why Elastic is actually insulated from it. Analysts at Morgan Stanley and JP Morgan noted that Block was creating a playbook for other tech companies. You are right about the theory. If autonomous AI agents execute workflows, traditional per-seat enterprise software demand shrinks. And because Elastic is viewed by algorithmic trading models as a high-beta proxy for AI, it got caught in this automated reevaluation. The algorithms sold it off alongside everything else.
Because the algorithms recognize that AI efficiency means fewer human users.
But Elastic's technological moats insulate them from this exact dynamic. They are not a per-seat utility. They're the underlying infrastructure enabling these exact AI efficiencies. You don't buy Elastic per employee. You buy it based on compute, storage, and the volume of data being vectorized for AI.
Yet the market treats them as collateral damage in the TAM contraction, regardless. When budgets shrink, IT departments consolidate everything.
The market is misjudging the revenue model, and the underlying data proves it. Just look at the customer behavior during this exact same quarter. We saw 14% year-over-year growth in customers spending over $100,000 in annual contract value. That cohort is now at 1,660 customers. But even more telling, there was a 30% growth in transactions over $1 million.
Which is a substantial upstream acceleration, I will grant you that.
It is massive. You simply do not see that kind of aggressive upstream momentum if enterprise clients are looking to trim their software budgets due to headcount reductions. They are expanding their contracts to $1 million because they are consolidating their critical AI workloads onto Elastic's platform to automate those old jobs.
That's a compelling argument, but have you considered the actual intent behind the institutional accumulation you're so optimistic about? You view the buy-side activity as an unadulterated vote of confidence. And yes, looking at the filings, AQR Capital Management increased their stake by 153.4%, adding 4.56 million shares. Point72 added nearly 2 million shares, which is a 235.7% increase. On the surface, that looks like smart money backing your infrastructure thesis. But you are glossing over the most consequential move in this entire narrative.
You are referring to Pictet Asset Management?
Precisely. Pictet's $489.2 million acquisition, they took a massive 6.2% stake, 6,412,736 shares. Crucially, they didn't file a standard 13G.
The passive investor filing.
Right. A 13G is what you file when you just want to park your money, trust the current management, and passively watch the stock grow. Pictet didn't do that. They filed a Schedule 13D. That is an activist form. It is a legal declaration. They explicitly stated their intent to engage the board on long-term strategy, governance, and leadership.
Activism doesn't automatically mean the underlying business is broken, though.
No, but it means the current execution is highly questionable. This isn't passive confidence. It's a glaring signal of necessary disruption and management uncertainty. When a Swiss asset manager drops $500 million and immediately demands boardroom engagement, they believe the complexity and risk of the asset have fundamentally changed.
That is an interesting point, though I would frame it differently. An activist filing certainly introduces a new, highly visible dynamic into the boardroom, but it fundamentally provides a floor for the asset. Pictet isn't stepping in to liquidate the company. They are stepping in because they see the exact same intrinsic value that the public market is currently mispricing. Which brings me to the mechanics of that panic. The market microstructure, specifically the dark pools.
The off-exchange trading on this equity has been staggering. Frankly, it is the primary reason I see so much structural risk. On February 17, 2026, the off-exchange short volume ratio hit 63.09%.
A number that sounds terrifying to a retail investor.
It should be terrifying. We are looking at high-frequency algorithmic trading driving the entire narrative of this stock. Entities like QuantBot selling 45,300 shares in massive sudden blocks. We are seeing the heavy use of delayed signature prints through European international desks.
Let's explain what those are for the listener, because signature print sounds like a conspiracy theory, but it is a standard institutional mechanism.
Fair enough.
A signature print is essentially a massive block trade executed by large institutions, often overseas, that gets reported to the tape with a delay. It allows these massive players to accumulate or dump huge positions without immediately moving the price on the lit exchange. Pause. So my issue is that this creates an artificial, highly volatile market. How can anyone trust the price discovery of an asset when the majority of its critical volume is hidden in dark pools and the short volume is hovering over 60%?
I am not convinced by that line of reasoning because it fundamentally misinterprets the mechanics of short volume in dark pools. As we said, a 63% short volume ratio sounds like the entire market is betting against the company. But in off-exchange venues, this isn't hedge funds betting on the stock to fail. This is actually designated market makers, firms like Citadel Securities and StoneX, internalizing buy orders.
They are technically shorting to facilitate the trade, yes, but it still artificially suppresses the lit price.
Let me use an analogy to make this crystal clear. Think of a market maker like a high-end car dealership. A massive institutional buyer comes in and says they want to buy 50,000 shares right now. The market maker doesn't have 50,000 shares sitting in their inventory, but they want to facilitate the trade. So they sell the shares short to the client to immediately fill the order, knowing they can quietly go into the market and buy those shares throughout the day to balance their books. So that massive short volume, it is actually a footprint of massive underlying buy-side demand.
But the impact on the retail investor is still severe volatility.
But it represents institutional support. When institutions use the alternative display facility, the ADF, to absorb the massive retail sell-off we saw on February 27th, it proves that the smart money was providing a structural floor for the asset. They were stepping in, absorbing the liquidity, when retail was capitulating based on the block news. That is stability, not instability.
I simply do not buy that. You can point to the alternative display facility and dark pool absorption all you want to explain away the volatility. But eventually, the technical execution and the valuation of the company have to align with near-term reality. The dark pools cannot prop up a stock indefinitely if the broader market loses faith.
But the growth story is intact. I just laid out the 19% CRPO growth.
Yes, you argue this is a fundamental AI infrastructure asset, but the forward-looking metrics are showing cracks. Near-term guidance deceleration has led highly respected analysts at TD Cowen and D.A. Davidson to trim their price targets to the $65 to $70 range. They aren't looking at dark pool mechanics. They are looking at how hard it is to actually close enterprise software deals right now.
Analyst targets lag behind the technology curve, always.
Perhaps. But if we're talking about institutional moves, let's not ignore the massive exits. You brought up AQR and .72 buying in, but previous major holders like Citadel Advisors exited 92.9% of their position. BlackRock trimmed 20.5% in late 2025. These aren't retail traders panicking over a headline. These are deep-pocketed institutions who see near-term execution risks that you are entirely dismissing.
I am not dismissing the execution risks, but I am contextualizing them within the valuation, because the valuation is where the disconnect becomes glaringly obvious. Elastic currently trades at a 4.03 times price-to-sales ratio.
Which is incredibly low for this sector.
Exactly. It is starkly below its high-growth peer average of 19.82 times. It is literally being priced like a legacy, slow-growth software company from 2015, not a generative AI leader in 2026. And you have to look at the actual technical execution happening right now. Their engineers just rolled out better binary quantization, or BBQ.
I will admit, BBQ sounds like absolute sci-fi jargon to most of the market.
It does. But what it actually means is revolutionary for their clients. It slashes the memory power needed to run these massive AI models by 2 orders of magnitude. It makes the technology vastly cheaper to operate. Furthermore, their Elasticsearch GPU plugins are now indexing data 12 times faster than traditional configurations. They are mathematically superior to their competitors right now.
That is a compelling argument, but have you considered that technical superiority doesn't always translate to immediate shareholder value? History is littered with companies that had the best tech but failed to monetize it efficiently.
But it translates to strategic dominance. And Elastic has a massive, undeniable advantage with the sovereign cloud. For European markets and top-secret government environments, the ability to run these AI models securely entirely on premises, without the data ever leaving the local, air-gapped environment, that is an asymmetric moat against cloud-native competitors. Elastic offers that.
The sovereign cloud is a strong narrative. I can see that. The defense and regulatory applications are very real. But it takes immense time to monetize government contracts. The reality today, right now, is a stock that requires activist intervention to realize its value, trading in an opaque ecosystem completely dominated by algorithmic firms. The risk profile is just inherently different and inherently more dangerous than what the Q3 earnings beat implies on paper.
To summarize my perspective on where we stand today, the fundamental data is undeniable, and the balance sheet is a fortress. Elastic is sitting on $1.248 billion in liquid assets. In fact, they have already completed 60% of their $500 million share repurchase program, retiring 3.8 million shares from the market.
Returning capital to shareholders is always a positive signal, certainly.
It is a massive signal of internal confidence. When you combine that aggressive capital allocation with the CRPO milestones we discussed, and the clear technological superiority of their platform, from the sovereign cloud to the better binary quantization, all indicators point to a temporarily mispriced AI powerhouse.
And to reiterate my position, you simply cannot separate the asset from the mechanics of its trading or the macro environment it exists in. The shifting enterprise TAM dynamics caused by AI efficiencies are real. Pause. When you combine that macro pressure with the aggressive activist pressure of Pictet's 13DA filing and the heavy reliance on dark pool liquidity, the complexity and risk of holding Elastic have fundamentally changed.
I think where we do find absolute convergence in this discussion is on the technology itself. Elastic's pivot to agentic AI and their hybrid cloud capabilities, specifically Cloud Connect, represent a legitimate, highly tangible advancement over open-source competitors like OpenSearch.
Agreed entirely. The capability to seamlessly handle complex vector search and effectively power autonomous AI agents, it is a real technological moat. The question is purely how the market chooses to value that technology during this turbulent economic transition.
Analyzing market microstructure, the dark pools, the delayed prints, the internalization, alongside traditional fundamentals like CRPO and revenue beats, reveals a much deeper, more complex narrative than surface-level price action ever could. The true financial impact of their sovereign cloud expansion and the long-term results of Pictet's activist engagement with the board remain to be fully explored in the coming quarters.
The data tells two incredibly compelling stories. The listener will have to weigh the undeniable strength of the fundamental growth against the very real structural market risks and boardroom complexities.
There's always more beneath the surface.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!